go into Pottery Barn and I said, hey, do you have any pillows? They're like, get out of here.
Does it make sense for a self-directed IRA to invest in real estate without loans or loans and have UBIT tax? How do you calculate the approximate UBIT tax when selecting properties to invest in? This is a great question. Welcome, everyone, to the Directed IRA podcast with Mat Sorensen and Mark Kohler. We're excited to be with you. The open forum episode, we're answering the people's questions, and we've got a lot of them left over from our webinar we did earlier. I have like a CSV file that's like
a monster.
Lengthy of questions.
Yeah, which is a nice little, gamer what do you say? It's kind of behind the scenes tip. We do a webinar every month. It's free. You can register at directedira.com, and it is very robust, very impactful, and people have kind of figured out, man, I'm going to go over to that webinar once in a while, and so we had a huge turnout this year. I mean, this month. So get over there if you haven't done that. Yeah, it's the black and white show. I went the black shirt. You went white. I kind of like it.
Yeah.
It's very modern.
Yeah.
All right. What do they call that? Mid-modern?
Mid-century modern?
Mid-century? That's not black and white.
That's not black and white.
I don't know what I'm talking about.
Okay.
All right. You do the first question.
Well, let's dig into it. We do know self-directed IRAs, though.
Yeah, we do.
We don't know style or design or something.
I go into Pottery Barn and I said, hey, do you have any pillows? They're like, get out of here. We have pillows.
All right.
I really did that.
Now, remember, you can put your questions in at directedira.com/podcast. We do have some questions there we're going to field, but like I said, a lot of these are going to come from the webinar. I don't even I've got over 100 questions, no kidding here. So I'm just going to hit a few of these. All right. First one that came from the webinar was, I know you can buy real estate in an IRA, but what about new construction? Are there IRA lenders that will do construction loans? What is the typical down payment percentage if so? Great question. Yes, your IRA could buy new construction. In fact, we just talked on the Main Street Business podcast about someone partnering their IRA with other people doing new construction. Totally doable. However, the non-recourse lenders that will typically loan to an IRA, I'm not aware of any of them that like to do new construction.
If this is new construction to rental, you think you're going to turnkey it and new construction and turn it into a rental, they'll line up for that. No?
Once it's completed, they'll lend to it.
Yeah.
They're not going to do a construction loan with draws and all that with your builder. They're not going to do that where you're building it. But they will, if you're buying a finished product that was new construction and the loan's coming in, where it's going to be a rental, they're all over it. So in the build process, I haven't ran across a non-recourse lender that will do it. All of them are going to lend once the property's done. Yeah. So you might need private money in that window or use the IRA cash or something like that, but that's
a tricky one because it's true. Because if I could say, use your IRA to buy the land, then go get the construction loan and then turn it into long-term financing with an IRA lender. But the problem is no construction lender is going to do that without your personal guarantee. So the takeaway for some of you that don't know this is what they're asking in this question is, how do I get a bank to loan to my IRA and they don't care about my FICO score? I'm not on it. I'm not a guarantor. Matt's got a chapter in his book on this, on non-recourse lending. Make sure you check it out because there are so many opportunities to use your IRA and use leverage. It's pretty cool. So, great question. All right, good. Throw out another one. This is good.
Okay. All right, here's another one.
I'm sorry. Yeah, Mark is taken. Mark's taken. Yeah. I appreciate the question, though. Thank you.
Yeah, he's not on the market. All right. Yeah. Sorry, guys.
Very flattering. Appreciate that.
Sorry, guys.
What? Man,
the ladies weren't asking, actually.
Oh, yeah. Oh, that was Tom in Illinois? Okay, sorry. All right. Well, okay.
That was Florida Beach Bum. He was asking.
My gosh.
All right. There's a question that said, I don't have the names of who asked these. This is a little more fun to throw in the names of your handles. But the question from the webinar was, does it make sense for a self-directed IRA to invest in real estate without loans or loans and have UBIT tax? How do you calculate the approximate UBIT tax when selecting properties to invest in? This is a great question. Okay. Now, what they're asking when they say UBIT is this version of UBIT called UDFI, Unrelated Debt Financed Income. We have separate podcasts and webinars on that. If you're like, I don't know what these guys are talking about, we get into it. It's a whole chapter in my book, the Self Directed IRA Handbook. Now, IRAs will pay a tax on the debt piece of the investment. So let me give you an example here of why they're asking this question.
And I'll answer the first part. I want to answer the first part, but you do this one. This is good.
So UDFI, which is this UBIT tax, it's a version of UBIT tax they're asking. let's say you bought a property for 100 grand. 40,000 of it was the IRA's cash, 60,000 was a loan. Now the IRS is like, cool, you can do that. It's got to be a non-recourse loan, and we've got all the banks that lend on these for you to buy rental properties.
I've
done it myself.
Yep,
yeah,
just
talked
last
about
question.
it. Okay, but the IRS comes down and says, all right, well, if you sell that property for 110 and you make $10,000, really 60% of that, 6,000, was from the debt. That wasn't the IRA's money. So we're going to tax you on that, and the tax would be the capital gains rate. Now the other 40% of that was the IRA's cash. That was 40,000 of the 100 was the IRA's cash, so 40%, 4,000 of the gain here. You got to follow me with the math. 4,000. They don't pay tax on that. That's the IRA's cash.
You said capital gain rate? I thought
yes, you get capital gain rate on the sell
on the UDFI.
Yes.
Okay.
Of 20%. So on 6,000 in that example, okay, because we had 60% debt, not IRA money in this. 6,000 is what would be subject to this tax at a 20% rate. You get capital gains rate, and that's the max rate. So you pay $1,200, okay? Now, I was able to buy more than double. I had double the purchasing power by getting this loan, and I only paid $1,200 on a 10,000 gain. I'm all over buying more properties with debt than just buying one property or limiting myself to 40,000 investable income. Let me say it another way. Let me give you another example.
Can I have a piece of paper, please?
Let's say that you have $100,000 in your IRA, and you could buy one property for 100 grand outright with cash, or you could buy three and put 33,000 down on each of them and get a non-recourse loan for the balance. What would you do? Well, I'm going to generate more overall return and gain by leveraging and getting the debt, buying more assets that can create more rental cash flow and more gain. And I'm only paying tax on the debt piece of it. And it's a max 20% rate on the gain. And again, it's only on the debt piece. So I'm definitely for using leverage, doing the non-recourse loans, buying more properties if possible. And remember, you're only paying this UDFI tax, which is the capital gains rate on sale. You're only paying that when the property sells, and only on the gain.
Okay. All right. I love it. I'm taking notes here. I love this show. I learned so much. It's funny. A lot of people say, man, you're so smart on the show or whatever. Well, you keep learning and stay in your lane. You get pretty good at it. But I'm telling you, and just another little shout out here from my amazing partner, Mat Sorensen. I've already made 2 notes today of things I've learned about these technical topics. Freaking A. I'm a lawyer and CPA for 20 years, and I'm still learning from
you're
Mat
the one
Sorensen.
that told me what a self-directed IRA was.
I know. And then I just turned off. I was like, no, I don't need to know anymore. All right. And we even brought in an expert that just walked in the studio that's going to come on for our next question, too. That's how Matt and I just know. The more you learn, the more you don't know.
Yeah.
It's crazy. You just figure it out. You're like, holy crap. Okay, I wanted to add this. Read the first part of that question. I love the first question.
Does it make sense for a self-directed IRA to invest in real estate without loans or with loans?
Okay. Let's look at that. There's a couple big competitors of ours. I won't say their names because I don't want to get a cease and desist nasty gram in the mail tomorrow. That say, oh, you shouldn't buy real estate in your IRA because you don't get the bonus depreciation and the cost seg and da, da, da. You should, real estate in an IRA doesn't make sense because you don't get all the tax benefits. Yeah, but I don't pay tax on I have a gain too. And that's point number 1. But here's the biggest underlying point. I don't care if it's real estate, a dump truck company, crypto, hard metals, precious metals, whatever. The question is, what is your rate of return in your IRA? That's all I care about. If you're killing it in the stock market and an ETF that's the best thing to slice bread and you're making X percent, I won't say a percent, whatever that percent is, and that's better than your risk tolerance for you. You're going to assess your risk tolerance, and that's the best rate of return you can get for your risk tolerance. Stay there. I'm cool. Do it.
Yeah.
But if you can go over and do real estate with or without a loan and double that and have a hard freaking asset, people, don't worry about the tax benefit. And if there's a tax like this, you got to do the math and go, what's my overall ROI? If it beats where you're at now, you come over here.
Yeah.
It's that easy.
Yeah, because that I love that. That was so good. Because that dumb response that we get and that company that's against it is basically what everybody else is doing. Okay, so I'm going to stay in my crappy mutual fund making a 6% annual return. Is that what I'm supposed to do? But that rental property over there, I could get 12% or 15% or 20% annual return, and it's a real asset. It's not going to go to zero. Like it's an actual property, like a physical thing, you know? So don't get caught up in these little differences. Let me say it another way on this. This isn't even hitting your 1040. The money you're making in your retirement account doesn't even hit your 1040. And this little tax we're talking about just a second ago, UDFI, is only when you're getting more debt to buy more assets. You can't even do that in a brokerage account with an IRA. If you got $40K in an IRA, you're buying $40K worth of stock or $40K worth of mutual funds. You're not buying a rental property of $100,000. You don't have $100,000 invested now that can grow. And so we're only paying tax on this little piece of money that you don't even have in the game in a brokerage account.
Yep. It's bottom line.
Yeah.
Bottom line. It's easy.
We got a little hot there. Got a little hot there.
I know, man. Just that company pisses me off. All right. I love this next question, and we're going to bring in our expert here. Let me pose the question so you're not standing up here just staring at the camera for a minute. We got Kyle McMillan, the CFO of Directed IRA. I even asked him back, can you unchain him from his desk and let him come down and be on the show?
Yeah.
He's like, yeah, bring him up.
Yeah.
Let's bring in this is the pitch hitter. Is that what you call him?
Well, he knows this way better than I do. So I was like, I don't.
He's the man. He's the man. Okay, so here's the issue. First, I'm going to combine two questions. This is a little longer, but it's really good. So let me pose the issue. First, I had Crypto Grandma. For those of you that were our Directed IRA Summit, SDIRA Summit, I need to talk about that.
Yeah, October 20th and 21st in Raleigh, North Carolina, or you can stream it virtual, SDIRASummit.com. Mark Kohler's going to be there. Matt Sorensen's going to be there. Some other great speakers. Learn all this stuff on self-directing, how to take control of your retirement, baby. Yeah,
get to SDIRASummit.com. If you're even listening to this podcast, it's a no-brainer. It is the best conference in the country on this freaking topic, period. And Matt and I will be there. It'll be fun. Just virtual in on it, whatever. Just go there right now as soon as you're done with the podcast and freaking sign up. The end. So anyway, we were at this summit 2 years ago in Phoenix, and crypto was, the rage at the time, and so a lot of people were using, and still do, crypto, metaverse, all sorts of goodies in their retirement accounts. And we had a crypto grandma, just adorable, in the front row.
Yeah.
Like, I'm trading crypto in my IRA, and half the room was like, what the hell?
Yeah.
She's 80 years old and she's knocking it out of the park. What?
Are all these millennials that think they're crypto whizzes?
Yeah,
she's got her IRA up there buying and selling it.
Yeah, after the first break, like all these millennials like crowd around her. What are you buying? What are you doing? And it was so fun. Anyway, she had a question for me and she sent it over, much like your webinar thing. We get a lot of questions offline. And she was like, hey, I'm doing my tax return for 22, which is due here in the next 3 to 4 weeks. And she's like, I think I over-contributed to my Roth. Now, see, anybody out there, if you're contributing to your Roth, there are income limits. If you make too much money, you want to get into the party. You want to go in the front door. I want to be in the Roth party. So you're like, sign me up. But if you make too much money, you don't get to walk in the front door. And sometimes we do our tax return after the fact. It's 2023, my 22 return's done. Oh my gosh, there's a K1 or I sold some stock. I made too much money. Oh, but I already put the money in my Roth. What do I do? Okay, that's posed question number one. Then we've got another question here from a Larry right here on the show. She says, I'm in 2023. I'm going to truncate your question, Larry. And I want to put in $6,500 in my Roth for this year. However, in the last few months, I got a raise on my W-2. I'm killing it. And I'm making more money. I can't put money in my Roth because I make too much money now. How do I convert those funds to Roth? Can I do that? What's this backdoor Roth thing? Great second question. You're going to get in on this, right, too? Right. Okay. Then she says, well, last year in 22, I didn't make too much money. I put money in my Roth. But now, what the heck? Can I combine them? Is it going to screw up my 22 Roth? Now I'm in 23. I'm just confused. So I love Larry. She's kind of in the middle of it now. We got Crypto Grandma that's like last year's returns hitting me. But here's the common theme. Over contributions to Roth can be complicated. So without any further ado, okay, I'm Kyle McMillan, would you please join us in the studio here? I'm going to let you sit. You're the master. I want you on the mic.
Awesome. Well, thanks for having me.
Thanks for being here.
Yeah.
Kyle's also a CPA. He's just a brainiac. All right, so I'm kind of leaning in here for those on the podcast. You don't see all this craziness, but okay, Kyle, we know there's three options. And I wanted to kind of just go through these. Number one, before my deadline, I can withdraw. I mean, tell us, what would you do? Like, you get people call the company and ask, Kyle, what do I do?
Yeah, so if you get to the point and you realize I've over-contributed, right? Maybe you were eligible to contribute directly to a Roth, and now you're not due to income, the income you made. At that time, you can do what is called a recharacterization. So you will take you recharacterize the portion, and it's a calculation of the gains and the losses gains or losses that are created in your account. But what you can do is say, I recharacterize the contributions that were made for the previous year, and you can push them to the next year. So
okay. I love you. But you said three different things, which I love. This is so good. You're loving my article here, too, because I was like, I've got to, this isn't my article. I was pulling different sources. I can withdraw. I can just take the money out.
Yes.
Boom. Done. I can recharacterize.
We don't like that article. Why do we like that one, dude?
I'm just saying, these are options. I can recharacterize and turn it into a traditional. Or third, I can say, let's just kick it to next year.
Correct.
So three different things.
Yep.
Now, for option one, which is kind of dumb, option one would be, I'll just take it out. There's no penalty. You have until when you file your return with extensions. So we're here in October. If you file an extension, all of a sudden you realize you jacked it up for last year. Let's say your money's tight or whatever, and you change your mind. You're like, I can just pull.
Exactly.
Just pull it.
Yep.
No
say,
penalty.
Hey, I contribute too much. I need to take it out. We can do that. Yep.
Okay.
But okay, yeah.
Yeah, but
you usually made more money. That's why.
Yeah. But here's an important point. Crypto could be down.
Correct. Yep.
So if my account value has gone down, I'm like, ooh.
Then the recharacterization amount would be smaller.
Yeah.
So it factors in gains or losses.
I love you. Okay, so the option two. Tell us what kind of form they would do or who they'd call. How does that work?
So it's my accounting team. You can work with Peter and Nguyen. So what we do is that we process a distribution, right? And if you just want to take it out, it's an excess contribution. We remove that from your account, right? And we take into consideration the gains or the losses.
Yeah. That's option one.
That's option one. Okay. You can also recharacterize to a future year. Say that maybe next year you don't project the same amount of income. You can take that amount, that calculation, and say, hey, I can contribute that amount to my Roth for 2023 instead of 2022. And we can help you facilitate that. And that's two separate forms. It's a distribution technically, and then you recontribute to the future year.
Okay, and so that would be Crypto Grandma's option two.
Yes.
She could say, oh, well, I didn't have that high enough income in 23. We'll just move it to 23.
Yep.
Can I ask this though? What if Crypto Grandma had put in $6,000 last year, or she probably could have done 7. She's got over 50. But hang with me, all right? She put in 6,000, and now it's worth 5. And so now we're gonna change it to the year of the contribution. Is that you've got a distribution and a new contribution? How is that working? What happened because it went down? Yeah,
so there's a formula. There's an IRS worksheet it takes into consideration the entire value of the account.
Yeah.
Mm-hmm. Right. And so it's a calculation. There's a formula on it, but essentially you take your fair market value when you made the contribution, the fair market value when you're recharacterizing the contribution, and it's the math that works out there. Okay. So it ends up being a lower recharacterization amount. Correct.
I love it. Now, option two in there was, instead of Grandma kicking it to 23, she goes, well, let's just call it IRA for last year. And she may go, oh, and you may say, well, she made too much money to do a Roth. Well, she made too much money to get a deductible traditional IRA contribution. But we say we don't care. And this goes to Elena's point. If you were to recharacterize it for 22 as a traditional, not kicking it to 23, not taking it out, I'm just going to call it a traditional for 22, mm-hmm. Then she just does a Roth conversion. Boom. So the recharacterization to traditional allows the Roth conversion, which was what Elena can do in 23. So Elena, you still make your contribution for 23, but just do it as a traditional.
Correct. Yeah.
And then we can convert to Roth.
Yes.
Do they do a form with you if they're going to? They still have to do the recharacterization to traditional.
Yes.
For 22.
Yep. So it would be you'd have to take it out of the Roth first, right? So there's a distribution request, take it out of the Roth, and then you contribute it to the traditional. And there would be a conversion form as well. That's the back door. You're converting funds from the traditional to the Roth account. and we can do that after. Correct.
Okay.
So let me just make sure everybody understands this. So, and let's go with the numbers again. Let's say she put in 6, and now the crypto's worth 5. Because it's always easy with cash, but and the numbers are the same. Now she's got 5. She has to take it back out of the Roth, but it comes in kind. And then can that crypto go right back into the traditional?
Yes. So
because she'd rebuy.
Because we're recharacterizing it over, and so the asset moves. Now it's in the traditional.
Yes.
And then we convert it back over to the Roth.
Yes. And we can do, since it's in this example, it's crypto, we can.
Or any asset. I'm just saying any asset is,
That's true. We know the fair market value of the asset.
Yeah.
Right. And so it's really a back end accounting thing for our team to process. Similar process. We just take process the money movement on the back end. We'd calculate the amount. We do a distribution, contribution, and a conversion. So really, the crypto wouldn't move. It's still in the crypto at the end of the day after all three things have happened. But the numbers are reported correctly to the IRS, and you get the proper tax
Freaking
forms.
love it. Okay, I got 2 more questions. This is so good. I'm nerding out here. Okay. So it went from 6 to 5. We're going to recharacterize to traditional for 22. Can she put in another 1,000 still? I kind of, as I came out of my mouth, I thought I already know the answer, I think. But she can't because of what deadline, everybody?
April 15th.
April 15th of
Deadline.
23. She missed that. So she can recharacterize her traditional, but she can't make up for that contribution because we're past April 15th.
Correct. Yep. And keep in mind the recharacterization deadline as well is the 15th of October. And if you filed your tax return, you may have to amend your tax return so that you can
Recharacterize.
Yeah.
Recharacterize,
Which
yes.
brings me to the second question I had. If there's no tax involved, does it even show up on my 1040? Do I need to tell my accountant I just did it?
Yes. Because 2 things are going to happen. I think it's like 8606 is the form, because you're going to have a new non-deductible contribution coming in. You're going to get a 1099 too, because then you're going to convert to Roth. So now this will be on your 23. Well, because the non-deductible contribution is technically a 2022 contribution.
Yeah.
So because when that money goes into the traditional, right, this is a non-deductible contribution. At Directed IRA or Fidelity or whoever you're doing this, they don't care. It's a traditional
Yeah,
contribution.
and your accountant doesn't care either.
Yeah.
A non-deductible doesn't even go on your return.
Well, no, it does. They got to put it on there because it's got to go on this 8606 to track if you're going to convert it to Roth. Because then you got to pick it up and say, I did convert it to Roth, but it's not taxable because I never took a deduction for it. So there is some stuff on the 1040.
This is good. All right. I love it. Fun stuff.
But then the Roth conversion is probably on next year's, on the 2023 return.
Yeah. But it's still
Yes,
non-deductible
it
for
is,
last
yep.
year.
Yeah.
Yep.
All right. Can I blow one last? Because I'm dying to ask the last question. Let's say in Matt's example, she put in the 6. Now it's worth 7. To recharacterize it, can she get the whole 7 to traditional, or does she have to pay tax on the 1,000? That's a
good.
That's a bomb.
Yeah, we've had this one before. I don't remember.
I don't remember it.
I don't remember off the top of my head.
My recollection is, I'm just going to throw it out there, is that as long as you do it before the deadline, there's no penalty and no tax.
I believe so. I believe you're right. I think that you can recharacterize the higher amount, right? And there's no 10% penalty on that, the amount that would be considered an excess, yes.
Yeah. Well, anyway, folks, if you're in this situation, make sure you get to your tax advisor at markjkohler.com. We have the Tax Pro Network. We have got training on this. In fact, this is going to be my training today. I'm going to talk to the accountants about it today and really unpack this. So get a Tax Pro and then call Kyle's and his team. This is where your IRA should be. Kyle, how do they get a hold of the team? What do they do? If they're in this situation, they get their accountant on the line and then they call Peter?
Yeah, call our team. Peter is a manager of the accounting team. He can take care of you. He handles these on a frequent basis. So, give us a call and he'll take care of you.
Kyle, thanks for joining us. You're
Thank
awesome,
you.
man.
Appreciate it.
Good stuff.
Thanks, Kyle.
It's good to have a young, strapping young man here on the show.
Yeah.
The ladies love it.
Yeah.
Or Tom in Illinois.
Yeah. The guys that were asking if Mark was available, they like him.
Yeah. All right.
He's also taken, guys.
Well, folks, I hope some of you are like, oh my gosh, they dove deep on that. But you know what? That's what this show's about.
Yeah, if anyone's still listening, we're here.
We're here. We're going to rock it. All right.
All right, let me ask.
Go ahead.
Okay, Whew, gosh, we just came out of excess contributions year end, and
You have an easy one?
trying to do backdoor conversions for people that didn't qualify for Roth. That's super complicated. So if that was like over your head and you're still listening, don't worry. That's a high level question. Hopefully you never have to deal with it.
Yeah.
All right. Now rolling in, we got Mike asking a super complicated question too.
Oh, you're going to go complicated? Okay. I got this Airbnb, which was.
But I'm going to go with it.
You do it. I follow your lead.
All right. Mike's asking a promote structured LLC. And when people say promote, that means they're getting ownership for kind of putting the investment together. Typically, there's something called a promote, like let's say a private equity fund or a real estate fund where the fund manager gets a piece of the profit, maybe a management fee. So that's what he's talking about here. He says, is it possible to form an LLC with a mix of people in self-directed IRAs and have different classes of ownership, whereby one class receives a promote after capital and preferred is repaid on another class? Similar to most private equity deals. I'd like to structure a deal waterfall as follows. Okay, now I'm not going to read this waterfall here because he's got Class A and Class B paid at 12% quarterly, and then 75% of capital going to A, and then 25% to B. He's got all this math on how he wants to do it. Let me say what the rules are in this. And this is in my book in the advanced section on the Self-Directed IRA Handbook in the advanced rules. IRAs can only invest money. So let me say it again. IRAs can only invest money and get ownership for investing money. So let's say that Mark and I do let's just say Mark and I do an LLC together. Let's say Mark's IRA puts in 50 grand and my IRA puts in 100 grand. And we split the ownership 50-50. Well, what the hell? My IRA had to put twice as much money in, and it only got 50% ownership. And
that's because it's me.
And Mark's like, yeah, but I found the deal, and I'm running the deal, and I'm running the operation. Okay. Well, your IRA doesn't get credit for that. Your IRA didn't do anything, and Mark can't personally get credit for it because he's a disqualified person. That'd be a privileged transaction. So the only way we're going to match up ownership here is if I
put in 75 and you put in 75.
Yeah, that's how it's going to work. All right, so you got to cough up 25K. All right. So we're going to redo that deal, by the way. You owe me 25 grand. No,
I knew there was a topic to end up in this whole thing.
I was wondering how I could weave that into today to get that 25K
That was from last week's conversation. That hurts. That hurts. Okay.
All right. So now when you get to a complex structure like this, it's the same rules. I'm going to give the same answer, Mike, well, what the heck did the IRA do? If it's getting some better deal than the Class B, the IRA is getting this promote or this preferred return that the Class B doesn't get, and you've got all these other investors here, then it's not going to work. And I always have people be like, well, my Roth IRA is getting this B, and we got this class of ownership, and it's getting a huge benefit. And all these other investors, Class B and people, get a different deal. That's not going to work. Yes, you can do it. That's out there in the investment space. But that ownership and that promote, that additional value, is typically to the fund manager for the work and services they're doing. We can't give it to your IRA. Your IRA doesn't do work and services, and it can't get credit for yours. All your IRA does is invest money. So now, here's where someone's done it right. Mitt Romney, right? Mitt Romney was doing this with his IRA, but they weren't doing it. They were doing it very smart. What they were doing is they created classes of stock. They had a high-risk class of stock that said, hey, and they put their IRAs in it, and they said, hey, if the first 10%, 20% of returns are going to go to the low-risk stock, and those people get paid first. Only after they get paid do we get the windfall and the majority of the future profits. And so they created a different class of stock, where if you were an investor, it might make sense to be like, I like this investment. I might do the Class B low risk, where I get paid first, whereas the Class A only gets paid after the low-risk preferred, but they get a higher proportion if we hit a freaking home run. And so they were doing some of that structuring, and that can be a little aggressive. He was even, some people brought that up in the Wall Street Journal and everything, how he's doing his IRA and these private equity deals, but they were doing it smart, and they had different share classes. In fact, sometimes Romney's IRA was in the preferred, in the low-risk one. Sometimes it was in the high-risk one, and he was kind of all over the place. So as long as you have a class of stock structure that makes sense, where there's different risk characteristics, you can have different classes. But, Mike, that was my answer. You definitely need to consult on that stuff. The lawyers at KKOS Lawyers can help with that at KKOSlawyers.com.
Yeah.
And also my chapter, if you haven't read the advanced section.
I may even lean, if you're going to make an appointment, go to Jerem. Jerem Bergeson's our SEC attorney in the office too, or even Mark Fetzer. If you went with Mark Fetzer
any of those guys
or
could-
Jerem,
yep.
I mean, most anyone could handle it.
Yeah.
But Jerem does, if you're doing a deal like this, you may need some PPM support.
And I kind of go over Romney's structure in my book and outline how the kind of the guidelines of how they did it and why it worked.
I like it. Okay.
Your structure, Mike, doesn't too.
All right. Well, in our last 5 minutes here, we got a good one, and I know Matt is also in the mix on this, so you could have personally, so you could have some fun with this. We're going to talk Airbnbs. One of my favorite topics: RVs, Airbnbs, Turo. I don't know. I'm the people's man. I like these little scrappy businesses.
Yeah.
All right. So an Airbnb. This is from Jeff. I want to purchase a $500,000 house to use as an Airbnb investment. Cool. I only have $400,000 in traditional IRA. Oh, well, boy, you're out of luck, I guess. What the hell? 400? Geez, buy two of them. Okay, which I'd like to transfer to a SDIRA LLC, but I also have $400,000 in non-IRA investment account. Is there any way I can use funds from both to invest in this house, paying $500,000 in cash? I'd prefer to avoid the added cost and complexity of a multi-member LLC. Oh, wouldn't you? All right. First of all, Jeff, I need to ask why you're buying this with cash. Your ROI is going to be dramatically improved by using a non-recourse loan. Even if you went with a 40% non-recourse or 50% or even a 30%, use some debt in this mix, man. Get some leverage out of this. $400,000 in a traditional IRA. We got non-recourse lenders that'll help you buy this all day long, but that excess 100 if you needed it, or put $200,000 down, and buy two of them. And you got a non-recourse lender. Well, Mark, I don't want to pay interest. Dude, it's about the ROI. That was the point earlier. Oh, I don't want to pay interest. Dude, what's your overall net return on the money? When you use leverage, you're making money off the bank. Freaking A. And 50% down on hard assets, you're going to be fine. All right. Now, okay, that's point number one. So maybe consider some debt. Now, if any of you out there want to combine IRA money with your money and go out and buy a rental, Airbnb or whatever, love it. But it's going to be a multi-member LLC. And just like Matt's example 5 minutes ago, your money, your IRA's money, it's going to be pro rata. So if you put in $400,000 with your IRA and your money is $100,000 to get to the 500, then that means you own personally 20% and your IRA owns 80%, because it's all about the dollars and a pro rata distribution of ownership. So you can't get around the multi-member in that, because you can't loan to your IRA can't loan to you. Just deal with the multi-member LLC. I get, and this is for everybody, not just Jeff. People, there is so much money to be made here by just doing it right. Don't try to get scrappy and cut corners and, I'm going to do this and do that. Just freaking A, you're going to have an ROI that doubles anything in Wall Street, and be doing it right. Do the 1065, do the multi-member LLC, maybe even get some non-recourse lending, meet with one of our attorneys that can help answer questions you're not even asking. You're going to love it.
All right, my final question.
Yes, sir.
That was great. A lot of good advice in there. That was good. This is from the webinar. Question was, does the single member LLC for the Roth IRA have to be a California LLC? I'm a California resident. No. Unless you're buying California properties.
Yeah, I was like, where are you buying property? That's what matters.
I don't know that I'd be buying an investment property in California, but maybe you got good deals. I don't know. So, but let's say you're buying a rental property in Missouri, okay? And you have a Missouri LLC. That's what we're going to do. If you have a rental property in Missouri, we're going to have a Missouri LLC on that. We're always setting up the LLC in the state you own the property. Now, the state of California may want to tax you $800 still. Just as like if you had a LLC in California, because they're going to well, are you the manager of this LLC? Are you doing work in California? And the Franchise Tax Board in California has a guide that says, if you have an LLC in Missouri, and they literally have this in there, this example, that's why I use Missouri. If you have an LLC in Missouri and you're a California resident, and that
you're the
LLC
manager,
has a rental property in Missouri, and you have a property manager in Missouri, and you call that property manager from California to check on the business, you just did business in California. And you owe the state $800. If you're sitting on the toilet in California thinking about your rental property in Missouri, you just did business in California, you owe the state $800.
And Missouri, you did business. Both places. You're on the toilet.
In California, though.
Yeah,
at your
but there's
home.
business happening in a couple places here.
Yeah.
I don't
mean,
know.
so
I don't know.
you
That's
know
a
what
good.
I mean. Doing business.
I love
You know what
it.
I mean.
Okay.
So,
now let me add this caveat. This is a loophole here that a lot of people get sucked into. Under the Franchise Tax Board rule, if you're the manager of that Missouri LLC, you need to pay the $800 minimum tax. But it doesn't mean you have to go to the Secretary of State and register the LLC in California. It just means you have to file Form 568. So you're going to file Form 568, pay your $800 minimum, you're out. Not fun, but that's if you want to play the FTB's rules. We have a lot of clients that are like, screw you, FTB, I'm not paying it. Come after me. And they are not piercing the veil for that $800. You might just have to reestablish an LLC, which could be cheaper than paying the $800 down the road. Whatever.
Yeah. I haven't really seen them go after this out-of-state LLC thing. They definitely go after it if you're doing business in California and you set up like a Nevada LLC and you're trying to get out of it and you got a rental in California. And this is for all LLCs, not just IRA LLCs. But for those of you not in California, don't worry about this. This is just a weird little thing in California because they have this $800 annual fee for LLCs and corporations that they just love collecting. You know,
they're a pain in the butt. Well, everybody, thank you for being here today. We love this show. We love this topic. We hope you share that same passion. If you've enjoyed the show, please give it a 5-star rating on any portal you might be catching the show. Get over to the the monthly webinar at directedira.com. Make sure you register for the SDIRA Summit at sdirasummit.com. And see you next week. Anything else?
No, just remember, stay calm. Self-directed.